trying to build wealth can feel overwhelming
Oh,
sometimes.
yeah.
It's like
Yeah.
all these options and risks,
Right.
and it's a lot to take in when you're just starting out.
Definitely. I think a lot of people feel that way.
But today we're diving into something that feels a bit more relaxed, a bit more get rich slowly kind of vibe.
Okay. I like that.
Yeah, it's all about dividend investing. And thankfully, the folks at Money on Main Street have given us some great materials to dig into.
Perfect.
So we've got their portfolio building ideas, document, a sample trial portfolio, and a divvy possibilities list.
Okay. So a good overview of the strategy and then some specific examples to look at.
Exactly. Let's jump right in with that portfolio building ideas document because
Sure.
there's this quote that really stood out to me.
Okay. I'm curious.
It says, being wealthy is not based on a certain amount of money. It is having enough money to live without depending on others, whether an employer, relative, or a government.
Wow. That's powerful.
Yeah,
It really shifts the focus, doesn't it?
right. It's not just about how much money you have.
It's about freedom.
Yeah. Genuine financial freedom.
Being able to make choices based on what matters to you, not because you're stuck in a job you hate or relying on someone else for support.
Totally. And the document goes on to outline why building a dividend portfolio could be the key to that kind of freedom.
Makes sense. Let's hear it.
Okay, so first off, they acknowledge that stock prices can be all over the place.
Oh, yeah. Up and down like a roller coaster.
Exactly. But over the long term, historically, the market has generally gone up.
Right. It's that long-term perspective that's crucial.
And that's where dividend investing comes in. Because even when prices are fluctuating, you've got those steady dividend payments coming in.
Like a reliable paycheck.
Exactly. So it helps smooth out the ride.
And those consistent dividend payers, they tend to be companies with a solid track record.
Yeah, that's what Money on Main Street emphasizes.
Uh-huh.
They even have these categories based on how long a company has been increasing its dividends.
Oh, right. The dividend kings, the dividend aristocrats, and the dividend contenders.
Yep. It's like a badge of honor for consistent dividend growth.
Exactly. The longer that track record, the more confident you can be in their ability to keep those dividends coming and even growing over time.
But you know what else I love about this approach?
What's that?
You don't have to be glued to the stock market ticker every second of the day.
Oh, that's a big one.
Right. No more obsessively checking prices and stressing over every little dip.
It's more about making informed decisions upfront, building a diversified portfolio, and then letting time and compound growth do their thing.
Exactly. It's that get rich slowly philosophy in action.
Though, let's be honest, it's still fun to check in on your investments sometimes.
Oh, absolutely.
Yeah.
I'm not saying we need to completely ignore the market, but it's liberating to know that you don't have to be constantly reacting to every little fluctuation.
I agree. It frees up so much mental energy.
Now, the document also gets real about some of the pitfalls that can trip up investors.
Okay, like what?
They talk about greed, fear, and short-sightedness as these big saboteurs of financial goals.
Oh, yeah, those emotional impulses can really get in the way.
Right. Greed might tempt you to chase risky investments.
And fear can lead to panic selling at the worst possible time.
Exactly. And short-sightedness can prevent you from seeing the long-term potential of a slow and steady approach.
It's so easy to get caught up in the hype and excitement, especially when you hear those stories about people making a fortune overnight.
Yeah, but this approach is all about patience, discipline, and sticking to your plan even when things get a bit bumpy.
Exactly. It's like running a marathon. You wouldn't sprint the first mile.
Perfect analogy.
Hmm.
So building wealth through dividend investing sounds promising in theory.
Right, but how do we put these principles into practice?
How do we actually build a portfolio? That's where the trial portfolio document comes in.
Exactly. It gives us a concrete example to work with.
Perfect.
Ah.
Let's dive in and see how it all comes together.
Okay, so this trial portfolio from Money on Main Street, it's actually structured in 3 tiers.
3 tiers. I'm intrigued. Tell me more.
Well, think of it like building a house. The first tier is your foundation, your core holdings. These are those reliable dividend-paying companies.
Ah, so these are like the blue chip stocks,
Hmm.
the ones that have weathered the storms.
Exactly. Companies known for their stability and consistent income generation.
Okay, that makes sense.
Oh.
Then what about the second tier?
So the second tier, this is where you might start adding in some companies with a bit more growth potential.
Okay, so a little more risk, but potentially higher rewards.
Right. They might be a bit more volatile in terms of price,
Got it.
but they offer the possibility of greater returns and dividend growth over time.
So you were balancing stability with growth.
Exactly. And then the third tier.
Yeah, the third tier, what's that all about?
That's where you might sprinkle in some growth companies.
Growth companies. But aren't we focused on dividends?
Right. But these companies might not be paying dividends yet.
Ah, I see.
They have strong potential for future appreciation, though.
So it's like a long-term bet.
Exactly.
So this trial portfolio, it's really demonstrating a diversified approach.
Absolutely. You're spreading the risk across different types of companies and industries.
Okay, that makes sense. Let's look at some specific examples from this trial portfolio.
Sure. So in Tier 1, we've got Realty Income, ticker symbol O.
Realty Income. Yeah, I've heard of them. They're a real estate investment trust, right?
That's right. REITs own and manage income-producing properties.
Like shopping malls and office buildings.
Exactly. And because of their structure, they have to distribute most of their profits to shareholders as dividends.
Ah, so they tend to have higher yields than other types of companies.
Exactly.
That makes them a good fit for that stable Tier 1.
Right. They're all about generating that consistent income.
Now, I was also looking at the aggressive dividend companies list, and there are some pretty eye-catching yields there. But I guess we have to be careful about just chasing high yields, right?
Absolutely. A very high yield can sometimes be a warning sign.
Okay, so it's not just about grabbing the biggest number we see.
Right. You want to understand why that yield is so high.
So we need to look at the company's financials, their debt levels, their long-term prospects.
Exactly. Make sure there's a solid foundation behind that dividend.
Because a high yield without a sustainable business model is not going to help us in the long run.
Exactly. It's like building a house on sand.
Okay, so due diligence is still key.
Always.
And I like how this trial portfolio encourages us to think about our own risk tolerance.
Right. Are you more comfortable with those stable Tier 1 holdings, or are you willing to allocate more to those potentially higher growth companies in Tier 2?
It's all about finding the right balance for your individual circumstances.
Exactly. And remember, this trial portfolio is just a starting point.
Right. We've also got that Divi possibilities list to explore.
Exactly. It's a much broader range of companies to consider.
So much research to do. And speaking of research, we've talked about those dividend kings, aristocrats, and contenders.
Right. Those are great starting points.
Are there any specific resources where people can find lists of these companies?
Absolutely. You can easily find those lists online.
Okay, perfect.
And many investment books and websites provide in-depth analyses of these companies.
So it's like we're dating these companies before we decide to invest.
I like that analogy. Get to know them, see how they behave in different situations.
Understand their long-term potential.
Exactly. Because we're aiming for long-term relationships here, not just a quick fling.
Okay, so we've got a lot to think about.
Yeah.
But I'm ready for the next step.
Well,
How do we actually evaluate these companies in more detail?
let's dive into that in the final part of our exploration.
Okay, so we've got this huge list of dividend possibilities.
Yeah, it's a lot to take in.
It is. We've talked about dividend kings and aristocrats and contenders and how those are good places to start.
Right, they've got that proven track record.
But how do we actually go beyond just the dividend history and really evaluate a company?
Well, a good place to begin is with their earnings.
Earnings.
Are they consistently profitable? Are those profits growing over time?
Makes sense. We want to see that upward trend.
Exactly, because consistent earnings growth suggests that the company is well managed.
Right, and that they're capable of generating the cash flow needed to support those dividend payments.
Exactly. Now, another important factor is debt.
Debt.
Mm-hmm.
Okay, I've heard that's something to watch out for.
Yeah, it can be tricky. A reasonable amount of debt can be used strategically to fuel growth.
Okay.
But too much debt can weigh a company down.
Right, because they've got those interest payments to make.
Exactly. And if interest rates rise, that can really eat into their profits.
And potentially impact their ability to pay those dividends.
Exactly.
Yeah.
So we want to see a manageable debt-to-equity ratio.
Okay, so not too much debt.
Right. But also not too little, because sometimes a bit of debt can actually be a good thing.
Interesting. Okay, so we've got earnings, we've got debt. What else should we be looking at?
Well, we also need to consider the company's long-term potential.
Ah, so thinking about the future.
Right, because the market is constantly changing.
Yeah, industries evolve, new technologies emerge.
Exactly.
Yeah.
So we want to make sure we're investing in companies that can adapt and thrive in that ever-changing landscape.
So how do we assess that long-term potential?
Well, we need to look beyond just the numbers and think about the bigger picture.
Okay.
What industry is the company in? Is that industry growing or shrinking?
Right. Are they in a dying industry or one that's poised for growth?
Exactly.
Yeah.
And what's the competitive landscape like? Are there any disruptive technologies or trends that could impact the company's future?
So we need to be thinking like futurists a little bit.
I like that. We want to invest in companies that are not only performing well today.
but also have a clear vision for the future.
Exactly. Are they investing in research and development? Are they adapting their products or services to meet changing customer needs? Are they expanding into new markets?
Okay, so those are all signs of a forward-thinking company.
Exactly. A company that's focused on long-term growth and innovation.
This is great. We've covered earnings, debt, industry trends, future potential.
It's like putting together a puzzle.
It is. But there's one piece I'm still curious about: cash flow,
Ah, yes. Cash flow. Cash flow is crucial.
because it's the actual cash coming in and going out, right?
Exactly.
Yeah.
Not just the profits on paper.
Okay, so even if a company is showing a profit, it might not actually have the cash on hand to pay those dividends.
Right, if their cash flow is weak.
Got it. So cash flow is definitely something we need to pay attention to.
Absolutely. It's the lifeblood of any business.
This has been so helpful. I feel like I have a much better understanding of how to evaluate companies for dividend investing.
I'm glad to hear that.
And you know what? Thinking back to that Money on Main Street quote about wealth being about freedom, not just a number,
Yeah, that was a powerful one.
it really makes me think about what's possible when you achieve financial independence.
It's incredibly empowering to know that you have options.
Exactly. And to our listeners, I encourage you to take what we've discussed today.
Dive into that Divi possibilities list.
Start researching those companies. See what resonates with you.
Maybe even try calculating your potential dividend income based on a hypothetical investment.
Oh, that's a fun exercise. And remember, folks, this is just the beginning,
Keep learning, keep exploring.
because the most important investment you can make is in yourself and your financial education.
Couldn't agree more. Thanks for joining us on this dividend investing journey.
And who knows, maybe one day you'll be sharing your own wisdom with the world.
Now that's something to aspire to.